Good evening. Welcome to the Loan Officer Training Series with the Mortgage Calculator. Tonight, we're going to be talking about how to structure a Fannie Mae HomeReady loan. So give us just a moment here and we'll get started shortly. All right, go ahead and drop a comment there in the chat as you tune in. All right, it looks like we are live on all the different platforms, so we can go ahead and get it started. We'll take the chat off the screen for now, but you can go ahead and drop comments and any questions you have there in the chat. So welcome everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a lender specializing in non-QM loans. And what we do every Tuesday, Wednesday, and Thursday evening at 7 p.m. Eastern is this loan officer training, where we do a in-depth training on a different loan topic. And today we're going to be talking about HomeReady loans. So Jose, if you are ready, let's go ahead and get into it.
Good evening, everybody. Thank you for joining us for tonight's training on Fannie Mae's HomeReady loan. Don't confuse this one with Freddie Mac's Home Possible, which is the sister program of this one, right? Fannie and Freddie are the two agencies that handle secondary for conventional loans and are the guidelines that we use. So, HomeReady is a 3% down option, right? And it is an affordable loan option. So, not necessarily just restricted to first time home buyers, although first time home buyers love this program because it does have lower MI and lower rates than your traditional 3% down program. So, let's get right into how to structure a Fannie Mae HomeReady loan. So, like always, like to give you the clinical definition first, right? What is a Fannie Mae Home Ready loan? It is a conventional community lending mortgage, and the key word there is community, which means that it is an affordable option. It is a conventional community lending mortgage that offers underwriting flexibilities, which we're going to get into, to qualified borrowers who meet specific income criteria. The Home Ready Mortgage is a standard product offering available to all Fannie Mae lenders. So, like I mentioned, being a community lending product, it is an affordable lending program. So, and a misconception on this program is that it is not restricted to first time home buyers only. You can actually own another property and qualify for this program. The main thing is that it is an affordable option, so there are going to be limits, which I'll get into shortly. It does offer lower interest rate than traditional 3% down conventional first time home buyer options. And then, like I mentioned, it also has reduced MI. So, who qualifies for a home ready loan? Well, I did mention that it is an affordable lending program. So the borrower's income needs to be at or below 80% of the area median income, also known as AMI, unless the property is located in a low to moderate income or a minority census tract. And I've included there the URL for going and checking the AMI. So this is the Fannie Mae AMI, area median income lookup tool. So this program, like all other conventional loan programs, is open to U.S. citizens, U.S. permanent residents, non-permanent resident aliens. And refresh your memories again. A non-permanent resident alien is a borrower who is legally authorized to work in the United States. They do not have their permanent residency card, also known as the green card, and they obviously are not U.S. citizens, but they are legally allowed to work in the U.S. either because they have a certain type of visa that allows them to work, or because they already have their work authorization document, their employment authorization document, the EAD card, work permit. And non-permanent resident aliens obviously qualifying as a non-permanent resident alien because they're legally working here in the U.S. would also have to have U.S. based credit and also be able to meet whatever income guidelines for the specific program. The HomeReady loan is an option for 1 to 4 unit properties. It is an option also for manufactured homes up to the max 97% loan to value, but only if the manufactured home meets the MH Advantage requirements. If you recall the manufactured home training recently, MH Advantage states that the property, the manufactured home itself, needs to be a newer style. Um, so I believe it's either 1990 or 1991. Can't exactly remember the cutoff date, but it has to meet the manufactured home advantage requirements to be able to fund a manufactured home, period. If it is an older manufactured home, then this 3% down home ready option is not an option. It is for primary residences only. And like all conventional loans, it is per the matrix a minimum 620 credit score. However, please beware that that does not mean that if the borrower has a 620 credit score that they're automatically going to qualify. You would need to get your DU approved eligible for this program option. Now, it does state in the general home ready guidelines that manual underwriting may be an option. However, that is going to depend on the actual investors to see if the investors are accepting manual underwriting on these files or if they have an overlay that would not allow it. Haven't been able to find one to do it. That's why I mentioned guideline says it, but there may be overlays where the investors will not do it. The, Home Ready is also for purchases and rate and term refinances only. No cash out refinances ever. Because remember, this is an affordable lending option, and it is meant for home ownership to buy a home or allow you to stay in the home by lowering the rate and letting you take advantage of the rate and term, but definitely not to allow you to cash out any money at these subsidized rates. Very important to note for a rate and term refi, the loan being refinanced needs to be owned by Fannie Mae. Needs to be a Fannie Mae loan. You can't rate and term refi an FHA loan into this product or a Freddie Mac loan or USDA or VA or any other type of loan into this Fannie Mae product. This can only be Fannie Mae to Fannie Mae. And per the Fannie Mae guidelines, borrowers may have up to 2 finance properties and still qualify for a home ready. So they could have their one property they may be leaving, and this property that they're buying would be 2 finance properties. So let's get into some transaction details here. So I did mention maximum 97% LTV. However, maximum CLTV of 105% when the first which home ready loan is being combined with a community second. So I would tell you to go check the guidelines for this product and then check the investor overlays for using community seconds, because there are a couple of our investors that will allow it. You just have to follow their specific instructions on how to combine it with the HomeReady. So that is a good option for your buyers that are low on the funds, right? Need that community second. This is a way to do it. ARMs, adjustable rate mortgages, are restricted to 5, 7, and 10-year ARMs only. So it can either be an ARM that's fixed for 5 years and then becomes an adjustable rate, one fixed for 7 years and then becomes an adjustable rate, or one fixed for 10 years and then becomes an adjustable rate. They do not accept 3-year, 1-year, or 6-month ARMs. Please note that there is a maximum loan to value of 95% if you have a non-occupant co-borrower. So that is one of the cool things on this program. It does allow non-occupant co-borrowers. However, again, they do then reduce the LTV to 95 from the maximum 97. Now, here's some pretty cool deals. If it's a 1-unit property purchase, the borrower is not required to come in with any money from their own personal funds if gift or grant funds are being used for what would be their down payment and their closing costs. Technically, you could have the cashless transaction if they're getting gift funds or grant funds to make up that portion that they would have to give, right? So that's for a 1-unit property only. For a 2 to 4 unit property purchase, the borrower is required to have 3% from their own personal funds, regardless of all the structuring being done, gift, grants, whatever. They got to come in with at least 3% of the purchase price if it's a 2 to 4 unit property, obviously because of the investment component. Now, home buyer education is not normally required for this program, but it is required if the borrower is a first-time home buyer. So if they happen to be a first-time home buyer, then you do have to do take the home buyer education. And also real interesting to note, gifts, grants, and community seconds, and up to 3% interest party contribution is allowable for LTVs of 90 to 97%. So that's a 3% interested party contribution, which would be seller, for example, realtor, lender. And then the gift, grants, and community seconds are not subject to that 3%. It's just letting you know that they do accept gifts, grants, and community seconds for LTVs between 90.01 and 97%. So let's discuss in a little bit more detail some of the program benefits, which I've already mentioned in a few of these slides for this HomeReady program. So I didn't mention before, but reserve requirements, whatever they may be, will be determined by DU. So there is no set, you got to have a minimum of 1 month, you got to have a minimum of 2 months. Whatever DU comes up with as a risk assessment for this loan will determine if there's going to be a reserve requirement. Now, I did mention reduced MI. So there is a reduced MI factor of 25% on 97% LTV instead of the usual 35% for the traditional 97% LTV first-time homebuyer option. What does this mean in real numbers? Well, I ran a quote for a 97% LTV purchase, $500,000 purchase. It was $485,000 loan. Obviously, good credit borrower with these low MIs. But on the traditional 3% down product, the mortgage insurance was $169.75. On the HomeReady MI product, the MI was $133.38. So you're looking at $36 roughly, $36.40 roughly difference, less expensive for the HomeReady MI. So that's like free money right there. And on top of that, I ran a couple of quote scenarios for that same loan. And the 3% down first time home buyer, which does have to be a first time home buyer for the traditional 3% down loan, that came in 7.125 at par, whereas the home ready option came in at 6.875 at par. So we're looking at a 0.25% better rate for the home ready option. And then I did talk about underwriting flexibilities, right? So we do have some innovative underwriting flexibilities, which doesn't just include the fact that it's 3% down and not a first-time home buyer, right? That's the first one. But where it really gets interesting for this program is, for example, rental unit, such as from an ADU, if it's a 1 unit property, or from a 2 to 4 unit property, and border income. So you can use rental unit income and border income to help qualify the borrower. You can also have non-occupant borrowers, such as the parents. There is, and I touched on this briefly, there is no minimum contribution from the borrower's own funds on 1 unit properties. Again, that's as long as the 3% down, which would be the usual requirement, is being obtained from gifts or grants, right? Because you do have to have the money. It's not just going to materialize on its own, but it doesn't, there is no minimum borrower contribution as we see on conventional loans. And I just did mention the gift or grant can be used to meet the 3% down requirement. Now, another great underwriting flexibility for this program is cash on hand. Now, how many times have you had a borrowers, they usually tend to be the first time home buyers too, that has money sitting around, right, under the mattress, quote unquote, not yet in the bank? So I will break it down for you in the next slide, because I know now people read that like, what? Explain that a little bit more, Jose. So cash on hand can be used with restrictions, which I'll cover in the next slide. And sweat equity can be used when working with an approved eligible program provider. Now, what is sweat equity, right? Sweat equity is the equity that you create when you yourself partake in some of the labor of the project of the home. So let's say your home was like a home ready renovation purchase program, right? And you are doing some of the work yourself through an approved eligible program provider that puts together these kind of programs where a borrower can participate in doing some of the work themselves, the painting, the cleanup, the simple stuff. But that's a way to allow you to build sweat equity so that you may not have all the money, but if you can work for it and then get the credit for it, why not, right? And this program does allow you to do that, but you do have to be working through an approved eligible program provider for these types of things, where they'll manage the construction and let you partake in the sweat equity. So in our last slide here, we're gonna break down, because I know everyone's wondering, what did he mean by border income can be used and cash on hand? Because how many times have we not had, right, border income on an application, and we've been stumped because it hasn't been put on a tax return. So, the common answer was, I'm sorry, if you're not reporting it on the Schedule E on your tax returns, we can't use it. Well, if it's home ready, you can do it, right? And I'm going to break it down there because the type's a little small. I had to make it a little small so it would fit, and had to condense it a little bit. So, border income up to 30% of the total income that is being used for the loan qualification can be used if the border, and the border, we're talking about the person that's renting, right? So if the border, and I'm going to run through the different bullet points, A, is not obligated on the mortgage loan and does not have an ownership interest in the property, right? So it definitely not anyone involved in the transaction, right? So that's the first bullet point. Second bullet point, if the borrower has lived with the borrower for the last 12 months. Third point, if the borrower can provide, and this is coming from, they're going to ask the borrower for this information, not the borrower, right? If the borrower can provide appropriate documentation to demonstrate a history of shared residency, such as a copy of their driver's license, bill, or bank statement that shows the borrower's address as being the same address as the borrower's address, right? So that's a pretty easy one there. Just got to prove you lived there for the past 12 months. And if the borrower also can demonstrate the payment of rental payments, this is critical, because if it's cash, they're out of gas. So they got to demonstrate payment of rental payments with documents such as copies of the canceled checks. It could be obviously transfers, ACH transfers, Venmo, right? A lot of people use Venmo or other cash apps to send money to people. That's documentable. What's not documentable is actual cash, right? How can you document cash? That's going to be a tough one, because they're asking the borrower to provide the proof that they paid, not the borrower to provide proof that they received. See, that's the tricky part there. So, and then what's another important detail there is to the borrower for the last 12 months, or at least 9 of the most recent 12 months, provided the rental income is averaged over 12 months. So they're giving you a break there, because sometimes maybe the borrower was paying with the cash app, but some months you were there and he just paid you in person, cash or whatever, but you have at least 9 documentable transactions. Well, they'll let you go with it, but then you got to average over 12, whatever your total income is received divided by 12 months. So you may shortchange yourself a little bit there, but you're still going to get the income, some of the income. The only issue you're not going to get the whole 12 months is if you didn't provide documentation for all 12 months. Now, if you have less than 9 months that are documented, then it's not going to work. The minimum threshold is 9. So that's border income. Very cool there. And it didn't say anything in the guidelines about having to provide a Schedule E, on a tax return either. Right? So I guess they feel that as long as the borrower can provide the proof of payment, what was received, then the money was actually received by the borrower. And the second one and last point we're touching on there is cash on hand. Man, oh man, I can remember all the times this has been an issue. However, it's not as easy as it seems, right? Because in order to be able to qualify to use that cash on hand, it really has to be a customer that's how they always handle their business, right? And then the bullet points there are: the lender must verify that the borrower customarily uses cash for expenses, right? So if they provide all their expenses of the month and you see that it's not paid via transfers or canceled checks, then you figure they're going to be paid cash, and the borrower would probably have to provide to you you'd have to put together some kind of documentation there to show, yep, these are his monthly expenses and this is how he pays them cash. Um, the funds that you are going to use for the transaction, the quote unquote cash on hand, must already be in the bank or in an escrow account at the time of application, or no less than 30 days prior to closing. So it's not a total cash on hand situation. Okay, I got $5,000 under my mattress. Okay, yeah, sure, let's bring it to closing. No, at least 30 days prior to closing, that money has to be deposited either in a bank account or the escrow account of the title company doing the deal. At least 30 days prior to closing. You're going to need a letter from the borrower disclosing the source of the funds and that they are not borrowed. And then this last bullet point is really the one that could make the cash on hand situation fall apart, is that the borrower's credit report and other verifications should indicate limited or no use of credit and limited or no depository relationship between the borrower and a financial institution. So you're really talking about, this is for a borrower with very limited credit. Maybe you had some non-traditional credit on top of that, and that his bank statements don't really show a lot of movement, uh, in their account. Because if they have the account like that, and then you're trying to give this, like a super busy account showing he's paying everything with his bank account, then all of a sudden you're trying to use the cash on hand exception here to HomeReady, it's probably not going to work. It's going to work for the borrower who fits the profile and who all of their documentation provided also fits the profile, and then that's something that would be accepted. Certainly not for the borrower that's just kept it at home because it was undeclared income kind of deal. We run into those every now and then. That's probably not going to work. So I've given you a few good pointers here on HomeReady. Hopefully enlighten some of you on some of the additional benefits and uses for HomeReady, how you could use it. Clarified to you all that this is not a program just for first-time home buyers. This is more of an affordable lending-based program. And also remember that if your borrower's income is above 80% of the area median income, but the census tract shows that is in a low to moderate income census tract or a minority census tract, then the borrower would be eligible for the program without income restrictions.
All right. Looks like we got a couple of questions here. So, one question, I guess we'll bring it up on the screen here, is non-permanent resident alien through HomeReady versus I-10 loan.
No, not exactly. An I-10 is a different category of borrower than the non-permanent resident alien. The I-10 does not have legal working status in the United States versus the non-permanent resident alien that does have legal working status in the United States. So an I-10 borrower is not going to have a social security number also. They're only going to have their I-10, which is the number that they need to be able to file their tax returns, because they're working here either through their own employment or some type of employment, right? So they are working here. They just don't have the document to show that they are able to legally work here. The I-10 borrower also is required to have U.S.-based credit, just like the non-permanent resident alien. So they're going to have to qualify for the income, also of whatever program type you're putting them through. But they're not the same type of borrower because, again, the non-permanent resident alien can qualify as long as they have the credit and the income and the work authorization. They can qualify for any program that any U.S. National borrower, be they citizen or permanent resident, can qualify for. So typically they can qualify for all the same programs versus the I-10 that is only can qualify for only the I-10 programs, which are very specific in nature.
Let's see here. Another question. Community seconds has to be returned when home is sold or refinanced.
Really can't answer that broad of a question because it really depends on the community second, right? There's forgivable options and then there's repayable options. Just like when we have our down payment assistance training that we do, that we combine with an FHA loan or USDA, which is more of a national based option. Those are both forgivable or repayable depending on the program selected. But the main thing to note on that is that you have to really look to the investor to see if they allow it in their overlays because Fannie Mae does allow it, but that doesn't necessarily mean that every investor that we do business with will allow it.
All right. Well, no more questions. I appreciate everybody tuning in. Remember, we do this at 7 p.m. Eastern every Tuesday, Wednesday, and Thursday evening where we go through a new loan officer training topic. So we will see you all tomorrow, 7 p.m. Eastern, for the next episode of the Loan Officer Training Series with the Mortgage Calculator. Have a great night, everyone.
Thanks, okay. Ronnie.